Should we ban credit default swaps? David Einhorn, famous hedge fund investor, says yes. Roger Ehrenberg, you say David Einhorn on this one doesn't know what he's talking about.
Yeah, I mean, David is definitely a zealot, and this is one of those things that he's taken a very strong stand on. I think he's misguided. The issues about credit default swaps really boil down to, I think, two elements. One is that they've been created in amounts that far exceed the physical assets that they're tied to. So you get this pure speculation.
500 people have insurance on one GM bond, GM going to zero, suddenly have to pay out 500x.
Right, so you've got 20 billion here and $1 billion of underlying, so you've got this asymmetry which creates perverse motives where people want to drive the company into bankruptcy. So that's one big thing. The other big thing is that they have not been liquid, so as a result, we don't have this kind of this clear capital that goes against them that you would if there was a central clearinghouse. So those two things together have made it this incredibly toxic asset class, which of course led to the bailout of AIG, which was a synthetic bailout of our Wall Street firms and our counterparts in Europe.
And so why is David Einhorn wrong to say that we should just strike the books of these things?
Because if you really look at these elements of what has made them bad, it's not that they're bad in and of themselves, it's that we haven't promulgated rules to say, look, you can only create derivatives to the extent that there's an underlying that you can deliver against it. So if we were to match $1 billion of CDS against this $1 billion GM bond, then you've actually got hedging. And it doesn't even need to be hedging, but as long as you can theoretically go out and deliver it, then you can actually have a one-to-one transaction, and you don't have that asymmetry of wanting to drive a company into bankruptcy.
So is this similar to basically putting out rules against naked shorting? Is it, if you take it into the normal stock world, there's been this huge controversy about naked shorting. There's only one share and you can sell it 1 billion times and drive the price to zero. Are you saying basically we do the same thing? We say, look, you've got to own the particular asset or what have you to...
Or borrow it. Right, so I think that's actually a very good metaphor, that you need to either have a locate on the bond to be able to deliver it into a short, or you need to own the bond yourself. And I think that goes a long way towards mitigating these kind of perverse incentives that created a lot of the problem. And then the other is moving them to exchanges, is because once you do this and you say, look, we're going to have these straightforward, simple instruments. We don't need all the crazy bells and whistles. We can agree on standard terms, which most of the broker-dealers have done through ISDA anyway. Just put it on the exchange and have central margining and central clearing. There it is. And then you've just got something where you're able to price another strip of the asset class, another piece of the balance sheet, and it's no different than a stock option.
And Einhorn's biggest point is the perverse incentive that you mentioned a little while ago, which is that you want to drive the company out of business because then you're going to get some huge payout on the insurance, even as though bondholders are crushed and the company's crushed. Why is that different than buying a whole bunch of puts and trying to drive a company out of business with rumor mongering and everything else?
I personally think it's not that different. And actually that was my point, is that I think there are healthy checks and balances in people being short a stock and people owning put options, much as they would being short a CDS. And if companies don't have the operational performance to justify killing the shorts, well, then maybe there's a good reason their stock price is going down.
Thanks, Roger.
Thanks, Henry.